Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European Business Editor here at the IB Times UK. The UK focused again today with the state-owned lender RBS giving its full-year results for 2012 this morning, and they do make for fascinating reading. The headline loss of 5.2 billion sterling is indeed arresting and does represent the fifth consecutive annual loss for the bank, which is 82% owned by the taxpayer. But digging underneath, the numbers really aren't that bad. From an operating profit point of view, the bank was indeed profitable. 3.5 billion sterling was that measurement. Now, the reason for the difference are manifold, but one of the most significant is the accounting charge that RBS had to take against the rising value of its debt in the financial marketplace. It's not an actual loss, it's more of a book loss, and as a result, that's the difference between the headline and the operating profit figure. RBS also had to set aside about £1 billion sterling to potentially compensate customers who were firstly missold payment protection insurance, and secondly, to small businesses who were potentially missold interest rate swap agreements. We've covered that story comprehensively here at the IB Times, so do check that out. But it measures again, or represents again, I should say, the measurement between that headline loss and the underlying operating profitability. And as a result, investors kind of relatively bullish, at least on face, about the prospects for the bank, and taxpayers should be as well, because management has said that they're probably a little bit closer to exiting government holding. Not exactly sure when or not exactly sure how it will take place, but nonetheless, we're getting closer to the day where the taxpayer will be able to exit that 82% stake. From a bonus perspective, the compensation pool is 23% lower on 2012 than it was the year before, but it's still 607 million sterling, and that is going to make a very uncomfortable reading for a lot of people who look at the level of fines that RBS had to pay, particularly against or to authorities here in the United Kingdom and in the United States with respect to LIBOR allegations. Now, regarding bonuses, the European Union decided late last night to agree on measures in which they could cap compensation for those in the financial sector to about 100% of salary. It still has to jump through a couple of more regulatory hoops, but it looks like they will be the first jurisdiction to put such a stringent cap on payments to bank executives and to traders, and it will be interesting to see what other jurisdictions ultimately follow suit. Broader markets are getting a little bit of support from comments from Mario Draghi, the president of the European Central Bank, last night. He basically said the ECB was a long way from tightening policy or exiting some of the more significant, extraordinary monetary policy measures they have in the marketplace right now, and that's lifting asset prices, as you might imagine. Another thing to look at is the dichotomy in economic expectations in the core and the periphery of Europe. We'll measure them in Germany first because unemployment fell unexpectedly there by about 3,000 to 2.92 million. Unemployment hit at 6.9%, and that's a 5-month low. Good news there. But in Spain, we had a deeper than expected contraction in the fourth quarter of 0.8% of GDP. That means the whole year shrank by about 1.4%, and the expectation is that Spain is probably going to miss EU-mandated deficit targets, which were already eased as a result of the austerity measures that were put through by the Prime Minister Mariano Rajoy. We'll cover all that and more if you visit us on the economy page. We'll see you tomorrow.